And then the other one, the indirect management charges, remember the 1.5, 1.6? This is being charged every day as well as the trustee fee as well. So the trustee fee will charge the fund and management fee will charge the fund as well. Alright? Okay, what does this annual management fee do? This is the money that the company takes for their operation. Everything is based on the management fee only. They cannot charge extra on the fund. They only can earn from the management fee only. For trustee, same thing. They are only paid using the trustee fee amount. Okay, another measurement that you need to remember, a formula, is called MER, Management Expense Ratio. How much of the money is being used to pay expenses? To manage the fund, how much percentage? So it's always based on percentage. The formula, fees and recoverable expenses, whatever charges they charge the fund, divided by the average fund size again. So the formula is always based on average fund size. And why they multiply by 100? Actually they multiply by 100%. So that is the amount is actually very small. It is in percentage. So example, you have something like that. Management fee 31,000, trustee fee 6,000, auditor fee 1,200, bank charges 2,400. You add up together, total is 41,000. But the fund size is 3.1 million. So you just divide, you get times 100%. Why? Or else the number becomes 0.0133. So you multiply by 100%, you get 1.33%. The fee, as I told you earlier, is being paid by the company to the Sharia advisor or Sharia committee. It's not inside here. So in your fund, the Sharia expenses are not part of the calculation. So the company pays the Sharia advisor or Sharia committee separately. Assuming one investor put in 100,000. Initial entry cost is 7%. So you must, whenever they talk about initial entry cost, you must be alert. This one need to work out the working money. Because why? They give you the entry cost. And first time, right? So the working money formula, you must be prepared to use already. And then the MER of 2% over 5 years. And the return of the fund is 12%. So your annualized return here is the net return. But the investment in the unit trust, the fund manager make 12%. But there is an expenses of 2%. So your calculation must be based on the net of effective rate of return of 10%. Why? You have to pay the expenses, right? So the fund manager make 12% from the investment, but minus 2% on the expenses, your net return for your working money is only 10%. That one you must understand. The working money is based on the 10% net, the rest are expenses. So how to get your working money? Invested amount divided by 1 plus service charge. So 1 plus 7%, you get 93,457. Your 100,000 become only invested 93. The 93, your net return is 12 minus 10 is 10%. So your 93 times the 10% for 5 years. So your formula here, you got your formula like this. Working money is equal to the present money, the begin money. 93,000 times 1 plus I, which is 10%. Net power of 5 years, you get 150,000. So your 100,000 becoming 150,000 in 5 years. Now we talk about financial planning process. The main purpose is to meet the individual life goals. Because when you talk to your client, you want to know what they want to do with their money in the future. Whatever plan they have, education, retirement, buying a house, getting married, you all need money. So you as a consultant, explain to your client, you need money, let me plan and help you to get what amount you need. How? By doing a proper planning. First thing, I need to know what you want. Second thing, how much time. Third thing, how much you have. So this is where you talk about the present and future finances. And the whole process is called financial planning. Where are the areas? 1, cash management. This is where your money in and out. Salary in, salary out. You take the expenses or you invest in the saving your money. Second one, risk management and insurance. You want to cover in case something happens to you, you have money to pay for your medical fees and the disability fees or damages. Because this one we talk about human life, we don't talk about property, okay? Property, you buy your property insurance, but we're talking about disability or critical illness. So those are all under insurance. And then investment planning. Investment planning where we can use unit trust to invest, help you to grow your money. Tax planning is also part of your area, but you are not good in tax, you may want to talk to the tax consultant. What we know is maybe the personal tax. You invest in PRS, you invest in this and that, you can get some waiver or that one you can help. But if you are above that one, you better get a tax person to help your client. And retirement. Retirement and estate planning, retirement you are okay. How much you spend your money, right? You plan for it. But estate planning is more on the will, wasiat, hibah. That's where when you are gone, what are you going to do with the rest of your money that is left behind? Who you want to give to? That is under the will, wasiat, and the hibah part. We have a short form, we call it the UDA bill. 6 steps. First, you understand the client. What do they want? Alright, build rapport with the prospect. You understand what they want, you make them trust you, and then they will start giving you all the necessary numbers and info. That's where you start to gather the data and you ask the questions. What you want, how you want it, where you want it, all these questions. You gather info from the client. And the third, you analyze what information you have given, taken just now. You analyze how much you need per month, what are the amount you need in the future, all that. You analyze the data using all the analysis and projection tools you have. Then after that, you prepare a plan and propose to the client. Mr. Client, after understanding your needs and understanding what you have, I already analyze, and these are the plans for you. Plan option A, option B, option C. You propose the plan for them. Then after you prepare, you propose, Mr. Client say, okay, I will take option A, this part, option B, this part, and you combine. That is where you execute, you implement the plan that they have. That is where you start investing for them, choosing the right funds for them. And after a few months, maybe 6 months or 1 year, or even 3 months, depending on the customer, you say, I will come back again maybe 6 months later, and if there's anything urgent or fast changing, I will contact you earlier. And then you review the step again. After review, you start understand, is there any new needs you need, any more changes to your requirement? And you get all new info and start again and again and again. This is called the financial planning cycle. If you do this with your client, they will stay with you forever. Okay, basically in unit trust, they have divided the people into 4 stages. Only stage 1 is when they start to buy car or this. So you must ask them to start planning for the future, for the house, for the getting married money. Stage 2 is where the children come in, education. Stage 3 is where they have to prepare for their retirement already, urgent, last minute already. If they never prepare earlier, this is the time they have to catch up. If not, gone. And stage 4 is when they're really retired. Whatever you have to spend. So what's the difference between unit trust consultant and financial planner? Both financial planner and unit trust consultant do analysis for the client. They also understand the objective of the client, and they need a unit trust consultant license, which means the FIMM exam. However, financial planner, they have higher level. They need a investment advisor license. And then you use your full skill of everything to plan for the client. Alright? So depending on what level you want to do this or you want to go higher. But everyone will have to do this basic. Okay? Anna? Alright, this is where the taxation slide comes in. Now you must understand the tax and the impact on the tax on your investment return. Let's say, for example, standard government say tax 10%. Clear? The government will tax 10%. And normally what do they tax on? Tax on your return, your investment return. Let's say your investment return is 5%. And the government say I will tax 10% on your investment return. So 5% times 10%. How much do you get? 0.5%. 0.5%. Don't tell me 50%. Huh? Why 0.5 times 10 or 10 times 0.5 5%. So you do this. 10% times 5% equals to what? 0.1 times 5% equals to 0.5%. You don't say 50%, huh? 0.1 times 5 equals 0.5. That's where you minus away the tax. You get 4.5% net of tax. You got 5% minus 0.5, you got here. You got 4.5% net. So okay? And then you got another friend called inflation coming. Your barang-barang you buy 5 years ago, and now there is a change in the price. The price increased higher, right? And then assuming your income tax is 10% on this, you got left 4.5, and then you got inflation of 4.8, 4.5 minus 4.8, you get a loss of 0.3. Basically, your money is reducing the value by 0.3% after income tax of 10% on your return plus the 4.8 inflation. So okay? Now to cover back the tax and inflation, you make sure your return are higher. Assuming now 10%, minus 10% of tax, 0.1 times 10 equals to 1. So okay? 0.1 times 10% equals to 1%. So you only left 9. So alright? 9 minus 4.8, you got net return of 4.2. So this one good. You are making more money than you were last year. If your return is 12, 10.8, 4.8, your net is 6%. So you are okay. Your return is plus 6% on top of tax and above inflation. The impact of the inflation will always cost you worse. Now let's say a house costs 150,000 a day. How much it will cost in 10 years time with the inflation rate of 4%, 4.8 or 5%. This is to calculate the price increase. Just to show you how the impact. Let's say the house was 150,000. Okay, at 10 years time, in 4%, how much the house value will be? How to calculate? Using your same formula. What formula? 1 plus I of n, isn't it? Future value, present, 1 plus I power of n. So future value is don't know. Present value is 150,000. 1 plus I, 4%. Power of 10 years. So you just solve the equation. So 1.04 power of 10. So you solve this equation times the 150,000. How much you get? 222,037. So your house 150,000 now will become 222,000 in 10 years time after inflation rate of 4% only. If it's 5%, you become 244,000. So you see 1% return difference or inflation difference after 10 years you can cost you quite a lot of percentage. More than 10% difference. Now, there's another formula that you need to remember. Whenever you see the number multiplied by 2 or half, then you know this is the rule 72 equation. It's nothing to do with the future value, present value. Okay, rule 72 say what? 72 divided by interest rate, you get the years. That's all. 72 divided by interest rate, you get the number of years. Whether to multiply double or become half. Become double is normally the house price, car price, and so on. Become half is more on the purchasing power, which normally don't have. You always have double up the money, not half one. Okay? You only remember the top one. The bottom one, forget it. What they say is, instead, let's say the house is 150,000 just now, right? Remember this one? If the house is 150,000, and I want to know how many years it becomes 300,000. If you want, you solve the equation like that. But if there's a faster way using the rule 72, say to double up from 150 to 300,000, you don't have to do all the mathematics of this. If you want, you can. But the easiest way, when you double up 150 to 300, you multiply by 2, you just use the 72 divided by how many percent? Let's say 5%, right? Let's say 72 divided by 5 equals number of years to make the 150,000 to 300,000. So 72 divided by 5, how many years? 14.4. Okay? So which means if your money is giving you 5% return every year, or inflation of 5% every year, to make it double, you need 14.4 years. That's all. Formula, the rule, you just say like that. If the return is 8%, so 72 divided by 8%, you get 9 years. Okay? This is the rule, say like that. Year is 72 divided by percent, you get year. If the other way around, 72 divided by 10 years, you get how many percent return? 7.2% to double up the money. If your house inflation is 7.2%, in 10 years, you double up the money. Just like that. 72 divided by year, you get percentage. 72 divided by percentage, you get number of years. To double up the money. It's always to double up the money. Right, that's an example. But the question normally are not as simple as what I showed to you here. This one, wow, so nice, the formula, so straightforward. The question, they will give you something like that. One example, Ali Ahmad invested Fund A, Fund B. And both get invested 100,000. And then both get 200,000 after a few years. So okay, double up, right? 100 become 200,000. When you whenever you see the number double up, it's rule 72 already. Ali Ahmad invested Fund A, Fund B. And both get invested 100,000. And then both get 200,000 after a few years. So okay, double up, right? 100 become 200,000. When you whenever you see the number double up, it's rule 72 already. But the question is, they ask you like this: Ahmad got back 8.67 years, he doubled up the money. But then Ali back 1.47 earlier. So you must know years and years. How many years is that? 1.47 years earlier, 8.67 minus 1.47 equals to how many years? 7.2. 72 divided by 7.2 years equal to 10%. That is the return Ali got. We talk about ethics. Ethics is where they give you guideline on the professional conduct and code of ethics. Alright? So FIMM, they got 3 parts, A, B, C. One for UTMC, one for ITA, one for part C for unit trust consultant. And the thing is, code of ethics and standard of professional conduct. Code of ethics say it's about yourself. How you do the business. It's all about internal, your heart. For example, professionalism. Are you professional in doing the business or not? Or are you chincai, can do, cannot do, don't bother, don't tell people this, don't tell people that. Or integrity. Are you telling the truth? The whole story correct or not? Or you try to bluff your way through. Or confidentiality. You keep your customer information confidential. You don't talk to everybody. And dignity. You carry the business with pride. You don't have to tell bad things about other people. You just maintain what is good about yourself and your product. As well as conflict of interest. If there's any charges, you let the customer know. Company will charge this, charge that, and the commission is this and that. So this is all on how you do the business, right? Okay, it's all about internal self. The other one is called standard of professional conduct. So there are 2 types. One, you comply with the law, and what happens if you break the law? Okay? Code of ethics are all about this. I mentioned this now. Honesty, dignity, integrity, fair dealing. You fair with customer, you tell them all the risks involved, all that. Good faith. The customer trusts you, you don't break the trust. right, competence, you are able to give the good advice to your client. If you are not able to do, you go and get somebody else to help you. And confidentiality, professionalism, acting with due care, skill and diligence. You really want to help the client, right? And efficient, prompt and continuous service. You keep on contacting them and servicing them on ongoing basis. This is about code of ethics, how you do the business. The professional conduct is the other way around. What you do with the business. First, you must follow the law. Second, you must bring your authorization card. Third, you must bring your title, unit trust consultant. Then you have about the prospectus, brochure. This is what you do with your business. Okay? These are more on external things. Right? Adequate explanation given, advertisement, you use company materials only, appointment of qualified person, we make sure we employ people who pass the exam, who have certificates and all that. Supervise and monitor. This is more for your downline and upline. Upline leader must monitor the downline, help them, guide them. Keep abreast of the industry, you keep on up to date, go for training. That's why you got CPD and all that. Plus, and understand about the disciplinary action taken if you break the rules and regulations. So all these are on the outside. How and what you use for the business. Okay? That is how you distinguish. Anything internal you, code of ethics. Anything outside of you, professional conduct. That is how you differentiate the two of them. So far, okay? If not, you're very confused. Is marketing? Yeah, both are very quiet, but is it internal or code of ethics or professional conduct? You ask yourself, is it inside me? Or my thinking or my heart? Marketing materials outside of me, right? Professional conduct. Integrity. Am I honest or not? You decide, right? Your heart, right? That is code of ethics. Easy to separate them out. Okay? These are the proceedings for discipline. They can complain to the company, complain to FIMM, complain to anybody, but the complaint must be in writing. But your disciplinary action. If you're serious like that, either termination, suspension, or just a fine or just a warning, depending on the seriousness.